Good afternoon, student. Here we are talking about another topic on principle of management, that is economic, financial, and quantitative analysis. The topic which will be discussed here: types of market, national income accounting identity, function, and its uses. So, before we start about the type structure of market, we should know what is a market. A market is any place where sellers of particular goods or services can meet with buyers of those goods and services. It creates the potential for a transaction to take place. The buyers must have something they can offer in exchange for the product to create a successful transaction. Now, here are types of market structure. As we have seen in economics, the definition of a market has a very wide scope. So, understandably, not all markets are the same or similar. We can characterize market structures based on the competitive levels and the nature of these markets. Let us study the four basic types of market structure. There are other determinants of market structure, such as the nature of the goods and products, the number of sellers, number of consumers, the nature of the product or service, economics of scale, etc. We will discuss the four basic types of market structure in any economy. One thing to remember is that not all these types of market structures actually exist. Some of them are just theoretical concepts, but they help us understand the principles behind the classifications of market structure. So, based on degree of competitive market will be four types. They are perfect competition, monopolistic competition, oligopoly, and monopoly. The first one will be perfect competition. In a perfect competition market structure, there are a large number of buyers and sellers. All the sellers of the market are small sellers in competition with each other. There is no one big seller with any significant influence of the market. So all the firms in such a market are price takers. There are certain assumptions when discussing the perfect competition. This is the reason a perfect competition market is pretty much a theoretical concept. These assumptions are as follows. The first one, the product on the markets are homogeneous, that is, they are completely identical. Second one, all firms only have the motive of profit maximization. Third one, there is free entry and exit from the market. That is, there are no barrier of the market. Anyone can enter into the market and exit into the market anytime. Last one, there is no concept of consumer preference. The second one is monopolistic competition. In monopolistic competition, there are still a large number of buyers as well as sellers, but they do not sell homogeneous products. The products are similar, but all sellers sell slightly differential products. Here, the consumers have the preference of choosing one product over another. The sellers can also charge a marginally higher price since they may enjoy some market power. So the sellers become the price setters to a certain extent. The third one is the oligopoly. In an oligopoly market, there are only a few firms in the market. The firm in this case either compete with another to collaborate together. They use their market influence to set the prices and in turn maximize their profit. So the consumers become the price takers. In an oligopoly, there are various barriers to entry in the market, and new firms find it difficult to establish themselves. The last one will be the monopoly. In a monopoly type of market structure, there is only one seller. So a single firm will control the entire market. It can set any price it wishes since it has all the market power. Consumers do not have any alternative and must pay the price set by the seller. Monopolies are extremely undesirable. Here, the consumer loses all their powers and market forces become irrelevant. However, a pure monopoly is very rare in reality. So, the examples of these type of market structure are given here. One by one, we can detail discuss it. The first one is monopoly. Google is undoubtedly one of the largest and clearest monopolies in the world. Google also controls about 60% of the global advertising revenue on the internet. One of the primary reasons smaller advertisers cannot compete is because they don't have the user data Google has. The next one is the monopolistic competition. The restaurant business, hotel and pubs, general specialist retailing, consumer services such as hairdressing, all are example of monopolistic competition. Third one is oligopoly. Coca-Cola and Pepsi, they are the example of oligopoly market. They are selling the homogeneous product, so they can control over price, but they will consider their action when they would like to change the price of their goods. The fourth one is the profit competition. Grocery market, soap, televisions, all are example of profit competition. So here a question is given to you that the cellular market or the cellular industry is an example of which of the following? Monopolistic competition, monopoly, profit competition, and oligopoly. Think yourself and answer. Now we are coming to the following topic, that is national income accounting. National income accounting is a set of principles and methods used to measure the income and production of a country. The most commonly used indicator of national output is the gross national product, that is GNP, which is a measure of the total market value of currently produced finished good and the value of services rendered. Because national output includes goods and services that are highly diverse in nature and some are not in fact placed on the market. The determination of market value is difficult and somewhat imprecise. The rule that only currently produced goods and services should be counted ensures that only production occurring in the course of a given year is included and any monetary transaction not related to the goods or service, that is unemployment or social security payments, gifts, are excluded here. The rule that only finished or final goods must be counted is necessary to avoid double or triple counting of raw materials, intermediates, products, and final products. For example, the value of automobiles already includes the value of the steel, glass, rubber, and other components that have been used to make them. National income may be derived from the GNP by making allowances for certain non-income costs included in the GNP, mainly the cost of the indirect taxes, subsidies, and the consumption of fixed capital or depreciation. National income, thus calculated, represents the aggregated income of the owners of the factor of production. It is the sum of wages, salaries, profit, interest, dividend, rent, and so on. Then, what is national income accounting identity? National income accounting identity is an equation that shows relationship between an economy's total income or expense and its different categories, that is personal consumption expenditure, private investment, government spending, net export and imports. The relationship can be rewritten as y is equal to c plus I plus g plus x plus m, where c is the personal consumption expenditure, I is the private investment, g is the government spending, x is the next exports and m is the imports. It is to national income accounting, but assets A equals to liability plus equity is to business accounting. The national income accounting identify it's effectively the definition of gross domestic product. So the factor or elements of national income accounting identities are gross domestic product, GDP per capita, gross national income, net national product. We will discuss each of the topic in detail in our next slides. First one will be gross domestic product. The most important number produced by the national income accounting is the gross domestic product, which is the market value of all goods and services produced within geographical boundaries of a country. GDP is a minus of total production that takes place inside the border of a country. It also a measure of total expenditure incurred on final goods and services and also a measure of total income. This is due to the circular flow of income, that is total income in an economy equal total expense. There are two variants of GDP, nominal GDP which is valued on production based on current prices and real GDP in inflation adjusted measure of GDP. All other indicators of national incomes are derived from GDP. The next will be GDP per capita. GDP per capita means the average income earned by a person in a country. It is calculated by dividing the total GDP by the country's population. The total gross domestic product is not comparable across economics because their size differ depending on the resources available to them, such as land, population, etc. But the GDP per capita is a standardized measure which enables comparison of standard of life across countries possible. The third one is the gross national income or GNI. GNI is the total amount of money earned by a nation's people and business. It is used to measure and track a nation's wealth from year to year. The number includes the nation's gross domestic product plus the income it receives from overseas sources. GNI is an alternative to gross domestic product GDP as a means of measuring and tracking a nation's wealth and is considered a more accurate indicator for some nations.